Are you a real estate investor tired of getting denied by conventional bank limits, but not desperate enough to pay the massive fees of a hard money loan? There's a secret middle ground that is helping investors scale massive rental portfolios, and it's called a DSCR loan. If you want to build real wealth in real estate, you need this tool in your tool belt. Common misconceptions about DSCR loans. Clearing the confusion. DSCR loans have gained popularity quickly, and with that have come a few misunderstandings in the investor community. Let's clear up a few myths. Misconception number one, DSCR loans are just like those risky no-doc loans that caused the 2008 crash. Not exactly. It's true that DSCR loans don't require income verification, which superficially sounds like the pre-2008 so-called liar loans. But today's DSCR loans are structured much more conservatively. They require substantial down payments, 15 to 25% or more, solid borrower credit, and sophisticated cash flow analysis, none of which was necessarily true for the worst loans of the pre-2008 era. In short, DSCR loans are a form of well-underwritten lending with real underwriting logic, not the wild speculation of the subprime era. In fact, many DSCR borrowers have excellent credit and track records. These loans aren't just being given out to anyone. As of 2026, performance data on DSCR loans, like default rates, has been relatively strong, indicating these loans are here to stay as a durable loan product in the market. Misconception number two, DSCR loans are the same as hard money loans. This is a common misconception. DSCR loans are not the same as hard money loans. Hard money typically refers to short-term loans like 6 to 18 months used for flips or rapid acquisitions. These loans come with very high interest rates, often 10 to 12% or more, significant points, and minimal underwriting beyond the property's collateral value. DSCR loans, by contrast, are long-term mortgages, typically with 30-year fixed terms with a fixed interest rate, designed for stabilized rental properties. While their interest rates are higher than conventional loans, they're usually in the single digits and far below typical hard money rates. DSCR loans also involve a more extensive and formal underwriting, including full appraisals, credit checks, and eligibility criteria based on the property cash flow. The confusion often arises because many private lenders offer both loan types, but they are entirely different products. The main similarities are that both are typically used for investment properties and generally do not require personal income documentation. But in purpose, pricing, and structure, they serve very different functions. Think of DSCR loans as the middle ground between conventional and hard money, albeit falling much closer in similarity to conventional loans in rates and terms than asset-based loans. DSCR loans are long-term, easier to qualify for than traditional mortgages, but with more structure and lower costs than hard money loans. In fact, many investors use both types of loans together, starting with a hard money loan to acquire and rehab a property quickly, then refinancing into a DSCR loan once the asset is rent ready, like in the BRRRR method. They can be complementary tools, not interchangeable. Time for an FAQ break. Can I use a DSCR loan for a fixer-upper or property that needs rehab? No. DSCR loans require the property be rent-ready and livable condition at closing. If major repairs are needed, you'll likely need to use a hard money loan first, then either refinance into a DSCR loan once the rehab is complete or sell the property after the improvements. Misconception number three. Anyone can get a DSCR loan. They don't check anything. This is false. While DSCR lending is more flexible, it's not a giveaway. You will need an adequate credit score, typically 620 plus minimum, but often 640, 660, or even 680 with some lenders. You'll need the down payment, closing cash and liquid asset reserves verified, and you'll need an appraisal to support the property value and market rent. DSCR lenders also often verify that you have insurance lined up, and they'll scrutinize the title report for any issues. They might not ask for your tax returns, but they absolutely do their homework on the collateral and your credit worthiness. So no, DSCR loans are not fog the mirror and you're approved. They're easier, but they still involve a proper underwriting process. Misconception number four. DSCR loans require a 1.25 DSCR no matter what. This is far from being true across the board. While a 1.25 DSCR ratio is a common threshold for many lenders and a good rule of thumb for a healthy deal, it is typically a threshold to get the best possible terms, not to qualify. DSCR lenders typically group loans in different buckets or ranges to help determine your interest rate and loan terms. For example, loans with DSCRs between 1 and 1.14 might be treated the same, and then loans with 1.15 to 1.24 DSCRs, the next bucket, will get slightly better terms and so on. Most lenders use 1.25x as a minimum to get the best possible terms from the portion of the pricing that comes from DSCR ratio analysis. Therefore, 1.25 DSCR will get you ideal terms on your loan, but it's generally going to be treated the same as higher ratios and is not a minimum requirement for qualification. This misconception likely stems from mixing up DSCR loans and commercial real estate loans, which both use the DSCR ratio and underwriting qualification, but use it very differently, both in formula and calculation and minimums. CRE lenders typically have that 1.25x DSCR minimum, but DSCR lenders do not, and with their trademark flexibility, will often offer loans with DSCR ratios near or even under 1. By the way, if you want to find out what rates and terms you qualify for right now, check the link in our description to access our 10-minute DSCR loan web application. Misconception number 5. My property doesn't have a tenant yet, so I can't get a DSCR loan. This is a misconception. You can get a DSCR loan on a vacant property. Lenders will typically use the appraiser's estimate of market rent to qualify the loan in these cases. In fact, many residential real estate purchases for rental properties are vacant homes or soon to be vacant after closing. As long as the market rent supports the loan, it's fine and common. It's important to note that vacant properties are perfectly fine for acquisition transactions and are actually the norm. In cases where the property is mismanaged by the seller with a lease in place that has significantly below market rents, a vacant property is actually viewed by the DSCR lender more favorably. Where borrowers on DSCR loans run into trouble with qualifying vacant properties is when the transaction is a refinance. This is because it begs the question, why is the property vacant? If the property is vacant because it's not leased due to mismanagement, then that's a red flag indicating that the borrower is not a good credit risk or that the market rent is inaccurate. Other explanations could be that the property is still undergoing renovations or that there might be occupancy fraud occurring. Regardless, all of these situations are nearly impossible for a DSCR lender to justify, and typically the lender will require the property to have a lease at least signed and in place before closing the refinance loan. Only in very rare cases can a borrower get a refinanced DSCR loan on a vacant property. Misconception number 6. Only experienced investors or those with big portfolios can get DSCR loans. Not true. DSCR loans are available to first-time real estate investors. There's no requirement that you own a minimum number of properties first. The typical profile of DSCR borrowers often skews to people who already have a few rentals and are expanding, but if you're buying your first rental and you have good credit and down payment, you can still use a DSCR loan to finance it. Of course, if you're brand new, do your homework. Lenders won't teach you how to be a landlord. They expect you to at least know what you're getting into. But from an eligibility standpoint, real estate investing newbies are not excluded. Misconception number 7. DSCR lenders don't care about credit. It's all about the property. This is another misconception. While property rental income is the primary qualifier, your personal credit score does matter significantly for DSCR loans. Nearly all programs have minimum credit requirements, and they tier rates by credit score. For example, a 740 plus FICO might get you a notably better interest rate than a 660 FICO on the same DSCR loan. The property's cash flow doesn't overcome a history of credit mismanagement. Some investors mistakenly think, oh, it's an asset-based loan, I can have a 600 score. While one might find a lender at 600, expect to bring a much bigger down payment and pay a much higher rate. A good rule of thumb is to aim for a 660 or higher credit score to get the best DSCR loan experience. Here's one last commonly asked question. Is a DSCR loan the same as a no-doc or a stated income loan? No. While DSCR loans don't require personal income documents like W-2s, tax returns, or pay stubs, which is similar to the stated income or no-doc loans of the past, they're not documentation free. Lenders still require documents like appraisals, rent schedules, leases, and often factor in credit score, reserves, and investor experience. DSCR loans skip income verification, but still involve real underwriting based on the property and the borrower, not just a stated number. And there you have it, the top misconceptions about DSCR loans, cleared up. While DSCR loans are an amazing tool, every real estate journey has its hurdles. If you want to learn how to navigate them like a pro, head over to harpooncapital.com and fill out our Contact Us form. When you do, we'll send you our completely free ebook, 10 Obstacles for DSCR Loans and How to Overcome Them. Don't forget to like this video, subscribe to the channel, and check the description for all the links we mentioned today. Happy investing, and we'll see you in the next video.